Hello, everybody. Welcome to September. My name is Julius de Kempenaer, and I'm presenting to you from Amsterdam in the Netherlands. The bad news is that it is September already, the ninth month of the year. The good news is that we have just completed the monthly bars for August. So this episode, this video is going to be about looking at the monthly charts for the sectors and then trying to put that into perspective on a monthly RRG and see if we can find something meaningful for at least a week ahead. Let's get started. Let me talk you through the monthly charts for the 11 sectors. And for this occasion, I'm using the indices, the indices, so not the ETFs, but the indices. And the reason for that is that these are true price returns and not the adjusted returns. And usually they have a little bit longer history as well, so that serves me right. Starting with the communication services sector, you can see how this is obviously still in an uptrend. Last month we closed top half of the range, I would say. Still a series of higher highs and higher lows, but you can see how the all-time high, and for this sector it goes back to 1999, is looming overhead. So that is around 330, I'd say, which is about 10% upside left. Very decent demand still for the communication services sector. If we go to consumer discretionary, again, I'm still labeling this as an uptrend. We've got higher highs, higher lows, but what you can see here is that we're struggling with overhead resistance around 1500, in that 1500 area. We had a monthly high in February of 1487, let's say 1490, and we're still at 1500. So not much has happened since February. And then if we break this, then the all-time high level, so the overhead resistance here, is around 1700. The chart is still okay. It hasn't turned over, hasn't rolled over. It's not a downtrend, but the longer it remains in that 1500 area, the bigger the odds or the higher the chance that we're actually going to see a bit of a decline, a bit of a rollover, corrective move, I'd say. We go to consumer staples. It's pretty different than what we saw for consumer discretionary, because here you see a very clean break. So consumer staples breaking above its all-time high and closing at the top end of the range for the month of August. That is definitely a good sign. So the consumer staples sector is showing a very nice clean break to the upside. And it's actually, I can argue here that we're breaking out of a range. So if we make that a little bit conservative, so that's 800, let's say 820, and this one here would be, say, 700, so that's 120 points over 800, so that's 920 points, and I'm being very, very modest here, so there's still some upside left for consumer staples. We go to energy. It's a different story. We spoke about the overhead resistance in the consumer discretionary sector, and staying at the same area, staying at the same level for quite some time. Now look at this. Look at the energy sector. So the all-time high here dates back to 2014. That's definitely an overhead resistance area that's in play. But it's already in play since 2022. Since May 2022, this level was tested, and we're still testing it. Now, the good news is that the lows underneath that test are still higher. So we've got higher lows, and we continuously run into resistance around that 720 area. We had one spike here in April to 756. But we closed at 715 in the same month. So quite a bit of overhead resistance to be expected around that 720 area. With the demand coming in every time at higher levels, this could be setting up as what we call an ascending triangle. And if that breaks to the upside, so if we take out that 720 area and then maybe that little flimmer of resistance here around 755, then there is quite some upside potential for the energy sector if that happens. The caveat is that it needs to happen. It needs to break that 720 area, and it needs to break that I'm going to say quite significantly, like the staples sector, like a nice clean break with a high closing price at near the high of the month. That would be ideal if we see that for the energy sector. If we look at financials, pretty much the same as staples. So we already peaked here in June 2022. Managed to stay below it, and then we hit that area again here in March of this year, and until last month, so a month before August, so July we broke, and then we're holding up pretty good. We're closing around the top of that bar, which is a strong sign, I would say, for the financial sector. Healthcare, just like staples and financials, breaking out of that range. We hit that area of resistance already in December 2021. That was around 1670, and then we tried to get out of it in February of this year, and then we stalled around 1735, and then last month a try, and then this month, so August, we really significantly broke above that resistance area, and healthcare is now definitely also a sector that broke out. So staples and healthcare, to a lesser degree financials, breaking out to the upside. And then here is industrials, basically continuing its uptrend. We already broke resistance back here and about a year ago. Well, not quite. The start of the year, January 2024. After a small period of consolidation since March, so March, April, May, June, July, and then August looks, July and August, both closing prices in the top of the range above that previous high here of March 2024. Things looking good, so still an uptrend for the industrial sector. And then here is information technology, everybody's baby, still in an uptrend. The last month, August, not too strong. We closed strong towards the higher end of the range, but the high of the month was well below the high of July, and the high of June was well below the high of July. So this is what I call a level one peak. You got the highs on both sides are lower than the high in this case of July. We've got to see and wait and see what happens in September. But in the end of the day, the higher highs and higher lows series is still in place. This is definitely not a negative chart. Just didn't manage to go above the highs of June and July because this is August. And then we have materials pushing against resistance. So the area where we now are was already reached in January 2022, December 21, January 22, and we're in that range again. So we got out of this range here back in March, and since then we're moving in that range between 547 and what's that, 590 for the last month. So the end of August was actually pretty strong. We closed towards the high of the bar and the upper end of the range. However, we do need a significant break above that 590 area to actually get back into the groove, get this sector back in a series of, so continuing the series of higher highs and higher lows. And then here is real estate, probably one of the more interesting sectors at the moment. You can see how it's been under pressure since the end of 2021. Very clear series of lower highs and lower lows, and then we hit bottom here around 205. That happened for the first time in November 2022, and then we did it again in October 2023. Started to work our way higher, and we're now clearing that overhead resistance that comes in between, let's say, 260 and 267, 260, 265 is a nice area, and we're above that. So if in the month of September we can continue this move higher, then there's absolutely upside potential. Every previous high is going to be some form of resistance, and the all-time high, the all-out resistance here is around 326, 327. But in that case, there is plenty of upside. And the good news by this kind of breaks, which we also saw in staples and healthcare, is that the former resistance that was broken is expected to act as support. So in terms of support and resistance, these are actually pretty good moves because you got the upside pretty decent and your downside risk is limited, or theoretically limited, to your previous resistance, which is now expected to act as support. It's the area where you can put stop loss levels or reevaluate your position. And then here is utilities. We saw healthcare and we saw staples breaking out to new highs. And this is the third defensive sector. Definitely a very strong chart, breaking above this resistance area where we started trading in May. So May, June, July, and then August we break higher. We close towards the end of towards the high end of the bar, but we're pretty close to all-time high resistance around 396, 395, 396. So here we do need the push through, the follow through to actually ignite the continuation of this uptrend. And the last chart that we're going to look at is the S&P 500, and you can see how it is continuing. It's higher highs, higher lows. We had a pretty wide range in the last month. We closed at the high. We didn't close at an all-time high. We closed at a closing high, but the actual high here is 5669.67 in July, and last month's high was just below that. So depending on how September will go, this could be a peak in the making or some form of a peak, and we will see a little bit of a decline, and the series of higher highs and higher lows is still there. There's no doubt about it. The only thing that will be my takeaway from just looking at these monthly charts is that the charts that are breaking to new highs and that are actually showing really good charts were healthcare, staples, and then financials and real estate. And staples and healthcare are definitely defensive sectors. Utilities is the third defensive sector. It didn't break to new highs, but it did break resistance, and it's on its way to challenge its all-time high. So these three defensive sectors are really standing out. And then there's financials and real estate, who are also doing very well. And that has all to do with the move in interest rates that we're currently seeing. So from a tactical point of view, and even with the S&P, at a closing high, but it didn't. So the high of this is June was 5523, and we closed this month at 5651. So there's not a massive move higher in 3 months' time, 2 months' time. And my caveat is, do we need more correction in the S&P 500 before we move higher? I'm pretty convinced we will be moving higher. The question is, will it happen right away, or do we need a little bit more of a corrective move? And with both healthcare and staples pushing to new all-time highs, and utilities breaking resistance and on its way to its all-time high, I am gonna put a little bit of caution, still caution. I mean, I think I've been using the word caution for the last 2-3 months already. We didn't really get a material decline. We didn't get any higher either. So the caution is still warranted. The individual charts of the sectors, there's not one sector that I would label a downtrend right now. So that should tell enough that the underlying strength for this market is still there. My problem is that the current strength is coming from the more defensive sectors and the interest rate sensitive sectors. And that is something that I want to see resolved before going for a blown out, all out bull market led by the super offensive sectors like discretionary, like communication services, like technology, because that's not happening at the moment. Let's take a look at how these sectors are now rotating on the monthly RRG. So here is the RRG for the 11 sectors. These are the ETFs for an RRG. It doesn't really matter that much. As a matter of fact, you really want to have the total return series for an RRG because it gives you a better view from the relative performance. And you can just select the monthly time frame here in the time frame box. Now, if you look at the result, then you can see a very clear picture where XLC and XLK are on the right-hand side. And obviously, these hold a lot of the mega cap stocks. Technology, as a matter of fact, I noticed last week is actually over 30% now. It always used to be around 25%. But right now, the technology sector is over 30% of the S&P 500. So go figure. And, communication services is not small either. And for that reason, because this is a closed universe, so when you would draw the vectors from all these endpoints to the center and you would weight them by market capitalization, you would end up by 0. So by default, we do have to have, because these are, especially tech is a heavyweight sector, we do need to have a lot of sectors on the other side to balance out that, that positive pool that's coming from the technology sector. Now, if we look at the rotations, and remember, we noticed on the monthly charts that the defensive sectors, so utilities, staples, and healthcare, were all looking pretty good. Now here is utilities. It's the lowest reading on the odds ratio scale, so from a relative perspective, it's the weakest, but it's picking up, and it's picking up rapidly. You can see how staples went through a correction. They're inside lagging. All of them are inside lagging, but this one is starting to pick up as well. And here is healthcare. Let me highlight that sector for you. Healthcare also starting to pick up, all inside the lagging quadrant, but all starting to pick up relative momentum. And that's a defensive rotation. Now again, it's still all on the left-hand side, so they're in relative downtrends, but they're rapidly picking up. And here are communication services and technology on the right-hand side, making almost opposite moves. They're on the right-hand side, so they're in relative uptrends, but they're losing momentum. And as I said, especially for the S&P 500, the uptrend is definitely there. Pretty much all these individual sectors are in. They're all in uptrends, and some of them are pushing against resistance, and maybe they're in for a little bit of a decline. So I think our job right now is to figure out whether we still need to see, or whether we are still going to see a corrective move within the uptrend, because I think that is what it is. It's a corrective move within the uptrend. But I'm not convinced that the decline that we had a couple of weeks ago was the correction. I do think we need a little bit more. And if I look at the RRG here, I can totally see a scenario playing out where communication services and technology are going to rotate further down, which will very, very likely have a negative impact on the S&P 500. Because the weight of these sectors is way bigger than utilities and staples. Healthcare is a pretty big sector, but probably not enough in its own to offset that. So where communication services and technology will see a little bit more of a setback, and then you will see a pickup in the defensive areas. And also, we haven't spoken about that yet, real estate and financials. Look at those two, financials and real estate. These are the sectors that are really improving now. They are on a monthly basis, have a very nice positive heading. Pretty much the only two sectors on a positive heading on the monthly scale, because utilities probably due north, maybe even slightly negative. But real estate and financials definitely doing very well. The question is whether that's enough to offset the pressure coming from communication services and technology. Looking at these tails, combining that with the monthly charts that we just looked at, my view for the time being remains that the S&P will very likely have a little bit more pressure on it, especially coming from communication services and technology. And we will get some upside from utility, staples, and healthcare, but the question is whether that will be enough to keep the S&P at current levels or even push it higher. I think the associated risks right now are not worth the return. That's probably the best way to phrase it. And despite the fact that this chart obviously looks super, super nice, you got to be careful not to get caught, at least if you're, I think, a swing trader, or you'd like to materialize on tactical moves that could be, I don't know, 5 to 10% to the downside and pick it up again. If you're a super long-term investor who doesn't care about a 10% decline, there's no reason to do anything. If you're a little bit more active and you want to play the markets and maybe play some sector rotation, I think this is a perfect market to do that. But keep in mind that the underlying trend for pretty much all sectors, as well as the S&P, is good. But the current sector rotation and the constellation, the behavior on the monthly price charts is positive for the defensive sectors, but discretionary, communication services, energy, they're pushing against resistance, and that stops them from moving higher, and especially the pressure, relative pressure on communication services and technology, combined with the upward pressure from the defensive sectors, probably going to keep the S&P at best at current levels, but maybe a little lower. And when is that going to change? When you will see communication services technology actually rotating back in and starting to pick up momentum and lead the market higher. Because with 30% market cap for the technology sector, it's very unlikely that we're going to see a full-fledged bull market without the participation of the technology sector. That's it for this week. I hope you enjoyed the show as usual. Please let us know, and I'm looking forward to seeing you again next week, same time, same place.